Mahesh Patil, Co-Chief Investment Officer at Birla Sun Life AMC is with us. Aditya Birla Sun Life AMC is with us. Good morning, Mahesh. Thanks a lot for joining us. So, Sensex is at all-time high. I'm sure, your investors are not feeling that, the market's at all-time high right now. Your thoughts on the kind of dichotomy that we've seen?
Yeah, that's true. I think the Nifty is an all-time high, but the breadth of the market has been very, very bad. And that's reflected in the statistic, year till date, if you look at Nifty is up around 7% or so, but the mid cap and the small cap index is down by around anywhere between 15 to 20%. And even within the Nifty itself, if you look at, it's been a very, if you look at the large cap stocks alone, right, large cap will be the top 100 companies. That's what SEBI defines now. So within that, if you look at the difference between the Nifty and the Nifty Next 50,
yes,
again there is a difference of almost 8 to 10 percentage points. And I was just looking at some data. Nifty itself, year till date, 5 stocks account for 120% of the Nifty gains. So they are more than the Nifty gains.
Yes.
So I think that's been of a challenge, because normally in the funds you would have stocks outside the Nifty to generate outperformance, which normally happens over a long, but I think in the last 9 months, I think
they're generating underperformance.
Yeah, so I think, so investors, again, not mid-cap, small-cap funds, I think would have seen slight erosion in the last 1 year or so.
How have fund flows been? Have they been deterred by this movement, this lack of performance in mid-cap indices?
So I think the fund flows started slowing down at the, especially after the budget. And there were various factors, the capital gains tax, then there was global concerns which were there, and then some macro headwinds, which we saw on the domestic side, as oil prices went up.
No, so Mahesh, let me interrupt. The June number was not all that bad if you took into account the Bharat 22 ETF flows.
Yeah.
So, if you took that as taking...
That Bharat 22 ETF is not actual genuine investment, right?
It's one-off.
A lot of the money which came into the Bharat 22 were actually people just paying the arbitrage over there. So a lot of arbitrage funds came in and they shorted.
Then in that case, equity fell by about 50%.
So in fact, the outflows, you'll see outflows coming in that ETF very swiftly. So I think the run rate definitely has come down. It's come down to around 10,000. So it's roughly a 40 to 50% fall from what we had in the previous year. And to that some extent, I think it is also a factor, not only the market also, but the broader, we've seen the interest rates move up, right? So a lot of money which came in. See, I think the inflow which came in last year, because after the demonetization, was kind of a one-off, because the huge liquidity which came into the banking system went in. So that clearly is going away. But the steady inflow, I think run rate should be around 10,000 crores or so on a monthly basis.
So, I'm going to come back to the mid-cap question, and Mahesh, it's interesting, SEBI has already clearly defined the boundaries. Mid-cap fund managers can only look at 100 stocks now, the 100 to actually 250, so 150 stocks.
Yeah.
And even in that tight universe of 150 stocks, there's so much of selling that's going on. What is the approach? What are you telling your colleagues managing these mid-cap funds now? And is there a lot of churn that's going on because of the market fall, or are you largely remaining invested?
So in the mid-cap, you're right, we have seen a lot of stocks come off, primarily because of, lower liquidity, lack of buying interest over there. And normally the fall in the mid-caps is much more severe, even though the fundamentals wouldn't have changed too much. So I think there is clearly a differentiation again with the mid-caps, which what we are making. A lot of mid-caps went up last year because of the good amount of liquidity. The valuations went up crazy in some of the stocks. So I think that froth is clearly giving away. But there are good quality mid-caps, where earnings growth is fairly strong, nothing wrong in those names, and outlook is looking good. So I think those stocks also would have corrected in this carnage what we have seen, and those clearly we see as a buying opportunity, not only in the mid-cap fund, but also across some of our funds. So I think after a long time, actually we are now seeing good value emerge in some of the mid-cap names, and actually selectively even in our multi-cap funds, where our mid-cap exposure, we would have paired it in the last 1 year because the valuations were higher. We are now looking at selectively to really add to those names. So I would say that if you are sticking to quality or conviction, should be really high in terms of earnings growth in those stocks. I think then we see the turnaround also very fast, right? The fall is also sharp in the mid-cap space. When things stabilize, again the rise also is equally sharp, but it will happen only in those names which have got fundamental strong story going forward.
Okay, by the way, Ashok Leyland is now down 5.5%. So I know you won't talk on individual stocks, but this whole derating that you have seen of some of these good quality stocks. Of course, Ashok Leyland is more driven by the recent news flow. Would this be an example where you would want to sort of accumulate stocks at lower levels?
Yeah, I think that could be, again, there are individual stocks, there are different drivers, okay, which could be driving that. I think wherever there are short-term concerns in any stock, I think market has been very punishing. Even in the quarterly numbers, we've seen that any slight disappointment, the stocks have been punished. So I think there could be a short-term some negative news flow which could be there, which could have a short-term impact. It doesn't really change the longer-term outlook over there. Clearly, in those stocks, if there is a correction because of slight disappointment in the quarter, I think that's clearly a buying opportunity in those names. As long as the medium next 1 or 2 year outlook remains fairly strong, because we've seen that even in this market also, wherever stocks have got beaten down and the companies have reported stable or good earnings, a surprise that stocks have also bounced back equally fast. We saw that yesterday in one of the banks, right?
Yes.
The stock it was beaten down and the numbers were fairly okay or slightly better than expectations, and there was a sharp bounce. So I think we need to really this time distinguish between the your high conviction bets. I mean, at least within our team also, we are sitting down and really focusing on companies, okay, where there is a high conviction by the analyst in terms of the future. Because I think, clearly, I think focus earnings growth and is going to be very critical for the stocks to outperform from here. It can't be just based on news flow.
Now, speaking of earnings, your reading of the way market reacted to HUL and then the general call on consumer, nothing wrong with numbers, fantastic margin improvement, good volume growth. The stock chose to sort of, pass it off as already priced in. Was that a one-off, or do you think consumer as a universe is susceptible to a similar reaction because of elevated expectations and valuations?
Again, I mean, a stock like HUL will be a classic, one of those 5 stocks, okay, in the Nifty, okay, which has done very well. And the valuations there had gone, I mean, well above the long-term average. It could be 2 standard deviations above the long-term average. So it's more about a question about, I think, the rally what we've seen in the stock before the results. I think it's giving away some of those gains, rather than I think reading too much into it. I think overall in the consumer pack, the earnings growth should be fairly good going forward, because consumption is looking strong. Rural, even Lever also indicated that the rural demand has been fairly good. And yeah, I think the stocks might, I mean, some of the consumer stocks have done well. I mean, Lever was one of them, but others have also done well. Where you might see some time correction over there, because the valuations have already factoring into some of this thing. And if at all there is a broader concern in the market, I think normally these stocks tend to hold on pretty well in that kind of environment.
No, Mahesh, HUL did report 12%, but that was on a zero-base growth the previous quarter. Ashok Leyland, people are now complaining, brokerage reports are now complaining that there is a loss in market share. Overall, are the I mean, it's not a great deal of results that have come, but from what has come, are you having a conviction that this is one of those great V-shaped years?
No, it's not going to be a V-shaped year, but clearly I think the earnings growth is starting to show up across the
So you are going with 20
yeah, so we are going at around 18% kind of a number for this year, which again, this quarter the base is also very favorable, so the numbers might look very good in certain cases, like you mentioned in case of Lever. That's not the actual, that's why we are looking at growth on a 2-year basis. So you look at FY18 vis-a-vis FY16 not 17, and that will be good indication in terms of what kind of a growth traction you are seeing in those names. But by and large, I think the numbers should be fairly good in this year, and across sectors. I mean, we've seen auto numbers have been fairly good. Consumption is looking up. Even banking and financials, the private banks, NBFCs, there was some concern, but the numbers I think there should be also fairly strong. Metals, despite some correction in the metal stocks, we haven't seen too much of price correction over this. That should also be fine. IT numbers which came in, which TCS reported again, was fairly I mean, good than slightly better than expectation. So I think we are fairly okay. We're not seeing any big V-shaped recovery, but clearly the trajectory is improving from what we have seen in the past few years.
On banks, I just had a question. Of course, the entire market is sort of very focused on private sector banks, largely retail focused. Is there a case to look at corporate lenders, and I'm not talking about PSU banks as an overall universe, but maybe stocks like Axis, just to give examples. I know we're not discussing stocks because of what Federal said yesterday. The fall in slippages was very significant on the corporate side of Federal's book. The loan growth has been very good across the board. Loan growth seems to be picking up even on the corporate side. So therefore, is there a case to look at corporate lenders that have been completely untouched for the last 1 year or more?
The corporate lenders, again, we have been looking at those names. I think if one is willing to overlook this year, because this year, again, you'll see a lot of cleanup happen. It has been recognized, but on the P&L, provisionings could be higher for a lot of these private banks, and they will use this opportunity to clean the books. Even India also would necessitate banks to take a hit. It might be done at the balance sheet level rather than the P&L. So I think if you are willing to overlook this fiscal year and take a slightly 3-year view, I think some of the corporate banks, private corporate banks, could be an interesting place to look at. I think the whole corporate cycle, credit cycle, has kind of peaked out. Credit growth in the corporate side is still a bit sluggish, but I think the way we are also seeing that the capex cycle is slowly starting to pick up. It's still early days, capacity utilizations are moving up. So if that kicks in a year down the line, I think you should see the corporate book also starting to grow. And with the provisions and the NPAs behind, as slippages start to come down, I think you should see better earnings growth and ROE improvement for the corporate banks, which could make them a good case to look at from a slightly longer term perspective.
Very quick numerical question. Your sectoral breakup, of course, I think this comes with a 1 month lag, is banking and financial 32%, autos 9.3%, technology 8.4%, oil and gas 7.4%. Which may you reduce, which may you increase?
Okay, so that's a tough question. Again, it will be driven more by stock specific. Again, like just to give an example, within oil and gas also we have seen a large divergence over there, right? I mean, we have seen some of the leading name like Lance do very well, and the oil marketing companies has been doing well. In banking and financial itself, you look at the divergence between the private banks, the corporate banks, the PSU banks, the NBFCs. So I think it will be more stock specific, and that's how we are going to trade this market in this fiscal year.
Fair point. Thank you very much, Mahesh Patil, for joining us with your thoughts this morning.